The Housing Assistance Council is a national nonprofit that supports affordable housing efforts throughout rural America. Since 1971, HAC has provided below-market financing for affordable housing and community development, technical assistance and training, research and information, and policy formulation to enable solutions for rural communities. Thank you for joining today's webinar, Nonprofit Finances for Non-Finance Professionals. With a focus on mission, nonprofit professionals have the skills to provide services and advocate for change. To achieve the mission, they are often called upon to understand the financial health of the organization. Join us for a discussion of nonprofit fiscal responsibilities and an overview of nonprofit financial statements. We'll look at a nonprofit organization's basic financial statements and supplemental reports, as well as the core aspects of the Form 990 and the audit report. Thank you to the Tides Foundation for sponsoring today's event. And now I'd like to introduce our speaker today. Trish Kelly is a senior manager with Markin's nonprofit social sector group. She joined the firm in May 2019 and has over 12 years of accounting experience, where she manages multiple teams to provide outsourced accounting and financial reporting for nonprofit organizations. In working with her clients, Trish oversees the development of reporting tools, processes and procedures, and internal controls, as well as the implementation of systems improvements. Trish is a CPA. She holds a certificate in advanced accounting, a JD in public interest law, a BS in finance, and a BS in liberal studies. Welcome, Trish.
Thank you. Appreciate it. Good afternoon. It is afternoon, and I imagine it's morning still for some people. Joining you today just to talk about what nonprofit finances are, what the aspects are everyone needs to be aware of, and just give you a big high-level overview. This is just an introductory course. I'm happy to answer sort of specific questions at the end of the presentation, but right now I'm just going to focus on sort of all aspects that you should know about, and then we can dig into the particulars. Okay, so I need to take control here. Okay, so this is the disclaimer that we need to share with everyone whenever we do a webinar, that this is just educational and is not financial advice. Okay, so today what we're going to look at is what is a nonprofit organization, how are they formed, and what obligations they have. Nonprofit budgeting, nonprofit financial statements, the audit process, and then the IRS Form 990. Okay, let's start with the basics. Not-for-profit is really a misnomer. And any organization needs to bring in a profit, or they're not going to survive. They need to bring in more revenue than they expend every year, or at least in most years, so that they can continue to operate and provide the services. So nonprofits are formed as what we call non-stock corporations. So they are formed under state law because all companies are formed under state law. They have articles of incorporation with a statement of purpose that shows that they are there to serve the common good. And they have bylaws, which provides the rules and the procedures. Their bylaws can be amended when needed by the board of directors, but that's what rules their day-to-day operations. So once they've formed the corporation under state law, then they file what's called a Form 1023 with the Internal Revenue Service asking for nonprofit status. For those of you who run nonprofits, just remember all of those documents must be kept at all times. I'm sure you've seen that funders and others want to see those documents years after the organization is formed. Okay, so what is a nonprofit? Under IRS, there are 29 different kinds of nonprofits. Most of us think of 501c3s. These are our charities. These are the organizations that can receive tax-deductible contributions from their donors. There's lots of others as well. We've got 501c4, which are member advocacy organizations, and C6s that are professional associations. You've also got social clubs, fraternal organizations, teachers' retirement funds, cemeteries. I mean, there's a slew of different types of nonprofits. And so when someone files that 1023, they explain what type of nonprofit they are asking to be under IRS law. Okay, let's focus on some accounting terminology next. First, GAAP. We've all heard GAAP, which is our generally accepted accounting policies. And what GAAP does is it provides rules that everyone has to follow. It means that one nonprofit's financial statements are equivalent to another nonprofit's financial statements. So you can have a major university and a small community nonprofit preschool, and they're both following the same rules of accounting. It means that you can look at the two sets of financial statements and compare them. That's all it's trying to do, is to make sure that we're all in, everyone's doing it the same way, so that we're not comparing apples and oranges, as they would say. Okay. Keeping the books. So when you keep the books for a nonprofit, we have two methods of accounting, cash and accrual. Cash is basically the way you run your own household, probably. Cash comes in and we record it as revenue the day we receive the cash. And when we write a check or we send money out, that's when the expense is recorded. Most nonprofits, however, operate under what we call the accrual method. And in the accrual method, we're tying the revenue to the period for the revenue, and we're tying the expenses to the period for the revenue. So that said, nonprofits are slightly different than other organizations or companies, because if we get a multi-year grant, we actually recognize a pledge or a multi-year grant in the year it is made. So that if we get a 5-year grant, we're going to record the whole 100,000 of that grant, even if it's meant to be 20,000 a year. That kind of messes up the budgeting for a nonprofit, but there are ways to work around that. Government grants are a little different because they tend to be recognized when the work is performed, so that we don't recognize the revenue until we've actually performed the work. So revenue and expenses are in the same month. Conferences, if we have a conference in January and our fiscal year starts in January 1st, we're going to do what we call defer that revenue, because we're not going to recognize it until the conference actually takes place, because we haven't earned the money until we have the conference. Dues we spread out over the course of the year in which the membership, mostly membership, is the period of the membership. Expenses are similar. We expense salaries during the pay period that the person performed the work. If we pay something in advance, we move that to prepaid expense, and we move it back out to the expense line item when the expense should be recognized. So if we put down a deposit on a hotel for that conference in January, we're not going to actually expense that until the conference takes place in January. If we pay something after the fact, say our pay period ended on December 31st, but we didn't get paid until January 7th, we're going to, what we call, accrue that expense. We're going to show that the expense was for that prior year, but it didn't get paid until the following year. So, tracking our revenue and our expenses. We have what we call dimensions, and we use, that terminology of coding an expense or coding revenue. So we have the core dimensions. We have our general ledger, which is our natural classification. That is our salary expense or our professional fees or our rent or those types of things. Everything has to be classified in that manner. But we also can classify it in other different dimensions, as we call them, in different ways. So we can show that we have a program that it's being charged to, or administrative, or to development. We might have grants that may even cross over some of those dimensions, a grant that funds multiple programs. So depending on what type of accounting system you use, we have different ways of showing those different things. It might be that you have different locations for your nonprofit, anything of that nature. We try to track those in our accounting system to the extent we can. However, we only really want to track them in our accounting system to the extent that they're useful as well. It's not really sort of a good use of our time to try to track something that we're not going to actually use. Okay, so everyone starts with the budget before the year starts. And I've created sort of a proposed budget for my non-existent nonprofit. I'm going to put it together with my management team and my staff, and we're going to really think about what our priorities are for the year, and we're going to present it to the board of directors. The board of directors should always be the ones to approve a budget before the fiscal year starts. It is the framework for the organization. where the organization wants to invest its resources. It really should tie to the organization's strategic plan. And in preparing a budget, you should always be looking out over the next 3 to 5 years, because this is what we're doing this year, but we're doing it this year as we build towards years 3, year 5, even year 10. So that's sort of the thinking that needs to go into the nonprofit's budget. And as you can see in this example, we're taking it and we're dividing it up. We're saying we have program A, we have program B, and we have development and administration. Development and administration are 2 categories of nonprofit expense you always have to track. It used to be that only the IRS required it out of everyone, but now the GAAP rules require all nonprofits to allocate based on program development or administration. So in this case, we're saying that program A is going to bring in quite a bit of revenue. And their expenses are actually going to be lower. So that program A, we're hoping actually shows that, net sort of increase in net assets. Program B, however, could be what might be a new program. And so we're showing that it's going to lose $42,000 for the year. But we're going to take assets from another program and move it over there. In this case, we're going to say that program A, with its extra money, is basically going to be helping fund other things to the extent it can. It all depends on sort of how restricted those assets are. But we put together our budget by program, and we present it to the board this way. They should know exactly which programs they're investing funds in. For instance, in this one, they're investing in program B, whereas in program A, it is funding itself. Development and administration always, well, not always, but usually do lose money. Organizations typically code their contributions or their event revenue to either development or administration. That's totally up to you, because revenue is not something that you're actually going to show by category to the Internal Revenue Service. So once we have our budget and we start our fiscal year, we're going to be producing financial statements throughout the year to show where we are as an organization. Our financial statements for nonprofits tend to be the statement of financial position, which is a snapshot in time. It is one day. So you're showing exactly where the organization was on that day. The statement of activities is the activity during a period of time. So you'll often see if it's the end of January and we work on a calendar year, it's going to be for the month ended January 31st. By the time June 30th rolls around, it would be for the 6 months ended June 30th, 2022 in our case. We're going to dig a little more into both of those, but we also have what are called the statement of cash flows and the statement of functional expenses. Most of my clients, for instance, don't do those statements on a regular basis. They wait until audit time to produce those 2 statements, but they are required financial statements for a nonprofit. Okay, so looking at the statement of financial position, we have what are called assets, liabilities, and net assets. Assets are what we have. Liabilities are what we owe or what we haven't earned yet. And net assets are what we have less. It's our net worth, just like in our own household. What our net worth is our assets less our liabilities equals, what we have left. Looking at assets here, we have cash and cash equivalents. That would be your bank accounts, your CDs, possibly even your investments, depending on what kind of investment you have. Your accounts receivable, that's money that someone else owes to you and you're expecting to receive. Prepaid expenses are expenses that we haven't incurred yet. It's something we have paid for already, but we won't be showing the expense yet. That could be, as we said, your conference, expenditures if the conference is happening in a later financial period, but it could also be things like subscriptions or insurance policies, things that last over a year or two, and you're going to spread out the expense over that period of time. And then we have our fixed assets. These are our computers, our furniture, maybe our buildings, or even our improvements to buildings, which would be called leasehold improvements. So these are things that we have what we call capitalized. We've said we purchase these, but they last over a period of time. And so we're going to show them over a period. We're going to show the expense over a period of time by depreciating that fixed asset. We also have liabilities. So accounts payable, that would be your regular, you've got an invoice in, you put it into the system and it's getting approved to be paid. So until it gets paid, it is an accounts payable. Accrued expenses, we talked about salaries earlier. If you close the year on December 31st and you don't get paid until January 7th, that would be an accrued expense, is what we owe our employees as of December 31st. Deferred revenue. This would be, for instance, our conference revenue. If people have sent in their sponsorship or their registration before, in the year before we actually have the conference, we would defer that revenue. We're not going to recognize the revenue until the conference takes place, so we defer it as of a period, a certain date and time. And finally, we have deferred rent. And deferred rent is that when we have a lease that's, say, 10, 15 years long, and the rent goes up every single year, but the landlord has given us maybe the first 6 months free to try to bring us into that space. As far as GAAP is concerned, we didn't get 6 months free. It's all contingent on us doing this 10 or 15-year lease. And so we do what we call straight line. We spread the rent expense over the entire period of the lease. So for that whole 10-year lease, we're going to have the same rent expense on the books every single month, even if our cash amount that we pay changes every month. And finally, net assets. So this is what's left over after we take our assets and subtract our liabilities. We have two types of net assets. We have without donor restrictions and with donor restrictions. And that word donor is key here. Only donors can restrict contributions, and we cannot change them to unrestricted until we've actually met the restriction that the donor has imposed. The two types of donor imposed restrictions we see most often are time and purpose. So it could be that a donor is giving us money, let's say it is that 3-year grant. And so they're going to give it to us in 3 pieces, and it's meant to fund the activities of the organization during that year. Even though we recognized all 3 years of the revenue at one time, we're going to unrestrict it as we meet that restriction, which is a time restriction. There might also be a purpose restriction, meaning that they have given it to us to perform a certain activity, and we cannot move that from restricted to unrestricted until we've actually performed the activity that is described in the grant. And that gives us our total net assets, our total net worth. As you see, total assets and total liabilities and net assets always equal each other, because assets minus liabilities does equal your net worth. So here we have our statement of activities. As you can see, we're showing it with 3 columns. One is without donor restrictions, one is with donor restrictions, and then you have your total. So as we discussed before, government grants, we recognize the revenue once we perform the service. And so that we show as without donor restrictions. Foundation grants, they can be either. A foundation can just give us money and say, here, please use this to fund your operations. Without any restrictions, we recognize it without donor restrictions. However, most foundation grants do come in with some type of restriction, so we put it over in our donor restricted column. Contributions tend to be without donor restrictions, can be with restrictions. Membership dues, conference sponsorships, as soon as we recognize it, those types of revenue are unrestricted in most instances. And then our net assets released from restrictions is the release of funds that we have recorded as revenue in the past. It could have been this year or it could have been in a prior year, but we're going to release it now. So we're going to say we're subtracting it from our revenue with donor restrictions, and we're moving it over to our revenue without donor restrictions, so that now we get to show it as without donor restrictions. Expenses, for the most part, are always without donor restrictions. And so then we show our change in net assets. So we are showing our change in our net worth. We add that to what we started with for our net assets, and then we show what our ending net assets are. And so that matches what we're going to show on our statement of financial position in that net asset column. Okay, so then we have our schedule of activities by department. Similar to our statement of activities, but now we're trying to really look at it not so much from a audit perspective, but from the perspective of we're trying to manage an organization and we're trying to see how we as an organization are doing by program. So we're showing what revenue we're bringing in by each and every program or by the department, be it development or admin, and then how our salaries are being paid out. Now, what you can see here is that, as I said, revenue is coming in according to what program it is funding. However, our expenses are going out by, in this case, natural class. We can also show our expenses going out by program, but because we've opened this up by column for the programs, we're not showing it down below that way. You see, we have salaries and fringe benefits. Those are allocated generally. Typically, those are allocated according to timesheets, because you have to have by, IRS and by GAAP rules, you have to have a good reason for how you are allocating expenses. So most organizations use timesheets to allocate their salaries, and then they allocate other expenses that are for the organization as a whole using that same allocation that they used for salaries. So they look at, once they spread out the salary expense by timesheet, and they use those percentages to allocate other items. Professional fees. Again, here we have them going into certain categories by what they were for. And we keep moving down. We take all of our expenses. Some of them are direct, some of them are not. So the direct could go to program A, could go to program B, to development, or to admin, or they can be what's called indirect. And those are going to be your expenses that are paid on behalf of the entire organization. So as we move down below, we look at rent and other expenses and indirect expense allocation. So you can see that we have certain rent payments that are directly expensed to certain programs, but then the majority of our rent is over in the admin column. Reason for this is we're, in this case, saying that admin's paying all the expenses that are for the organization as a whole, and they're going to take those expenses that they paid on behalf of everybody, and they're going to allocate them out. So when we look down below at our indirect expense allocation, you'll see that we have a negative in the admin column. So we're taking expenses out of up above, and we're allocating them over to program A, program B, and development. This is not, however, how we would do it on a statement of functional expense, just, which I said most of us won't do until the audit, but when we do it for the audit, we actually have to reopen it up. So we're going to move those indirect expenses over exactly by what kind of expense they are. So it's going to be rent, or it's going to be professional fees, or whatever it is. Some of those indirect expenses beyond rent would be, let's imagine that those professional fees included some IT support fees. We're not going to figure out who the IT person helped in each and every instance. We're going to take those indirect expenses that are for the organization as a whole, and we're going to spread them out, again, using the allocations of salaries. So then we show our change in net assets. Down below, you can see I'm tracking our percentage of spending. It's always important for a nonprofit organization, particularly a 501c3, a charitable organization, to track exactly how their expenses are being allocated among those different departments, because of the fact that some funders really care. We all know United Way cares. Some of the organizations that track nonprofit organizations are also watching this. That sort of old rule of thumb is that you want to keep your program expenses at 75% or above. In this case, you can see we have program expenses at 85%. So this organization is really sort of focused on the programs, and their spending reflects that, which is a good thing. Not always possible, especially in the early years of a nonprofit. When you form a nonprofit, it is very hard to have your program expenses at 75%, because so much of what you do in the beginning is that setting up your organization and getting things ready to go. Expenses like accounting and human resources are not expenses that can be allocated. They must stay over in the admin column. So that's why it's really hard for a new nonprofit to reach a 75% threshold, but it's always something we can always work towards. In some organizations, it's just not ever possible. Just the nature of whoever that organization is or what they do, it might not really be possible. As I mentioned before, the schedule of functional expenses would look a little bit like this. You'd take off the revenue because you're only looking at the expenses, but we would have to reclassify those indirect expense allocations according to what the actual type of expenses. We'd still get to allocate them, but we have to move them up on the schedule. Okay, so this is the key document that we all use day to day just to make sure that each and every program and aspect of the organization is on track. Because as we talked about, our budget is our guide for the year because we have worked with our board, we have worked with the entire team, we've decided how we want to invest our resources. And so we need to track our actual spending according to that budget. Now, management typically, it all depends on the organization, has the ability to shift priorities a little bit. So let's say we lose a key staff member. They're going to spend more on professional fees to try to get the work done while they try to rehire. So they might come in below on salaries and fringe and come in above on professional fees. Most organizations provide management the ability to maneuver within that without going back to the board for a change in the budget. I typically do not recommend going back to the board to change your budget unless you really foresee your budget being off by more than 5 to 10%, because you don't want the board involved day to day, but they should be there to support you. I also find that it's very helpful to bring the board back in if you see a big change and you're anticipating coming in differently, especially if you're bringing in more revenue or you are bringing, you've got some added expenses you had not anticipated. If you're going to be looking for foundation grants at the end of the year, you want a new budget so that you can use that to drum up funding for the following year, because they're going to be asking you for your budget for the current year as you get ready to do your budget for next year. So there are instances where you want to change, but otherwise you want to use that budget all year long as your guide for the year and track against it and see how you're doing. It's not true that you will always be the same. For instance, here we have the 2 months ended February 28th. Well, that doesn't mean that every single expense or revenue piece should be 1/6 of the year. Because of the fact that you could have some expenses that are higher in January, you could have some that are higher in November, December. Contributions typically are higher at the end of the year. So it all depends on the organization. Okay. Once we close the year, we have produced our financial statement for year end. Most organizations have to get an audit. It's usually required by either states because you're soliciting contributions in their jurisdiction. It could be required by your funders, your board, lots of other reasons why you could need an audit of your financial statements each year. An audit is an independent examination of the nonprofit's financial statements. So it is an independent entity that must do your audit. You have to hire an accounting firm that has nothing to do with the organization and doesn't have ties to the organization to perform the audit. And they're going to adhere to GAAP again, the generally accepted accounting principles. It is the board that hires the auditors. They're the ones who ask the auditors come in and make sure that the organization is complying with GAAP. Audits usually happen 1 to 4, maybe even 6 months after year end, because you generally do your audit before you're going to prepare your Form 990 for year end. And so the auditors have come in, and the auditor's job is to express an opinion. Now, most auditors do a lot more than that for us. They will help us sort of draft our footnotes to our financial statements and make our financial statements look great. I typically have my auditors do my cash flow. They do it all the time. I don't do those very often, but their real job is only to express an opinion. And they're going to decide whether they're going to give you an unqualified opinion, a qualified opinion, an adverse opinion, or even a disclaimer of an opinion. So an unqualified opinion is what we call a clean audit. It means that they are saying that they have no reason to suspect that there's any material misstatements in your financial statements. A qualified opinion would say that the auditors found one or two situations where the nonprofit is not following GAAP. An adverse opinion means the auditors found a material misstatement where they determine the organization's financial statements do not adhere to GAAP. And finally, a disclaimer of opinion says that an auditor found that there was something that prevented them from forming an opinion. So your goal is always to get an unqualified opinion. Most funders, anyone interested in the organization wants to see that unqualified opinion. So organizations work to, and you can work with your auditors even. Like if we have a question about something that should we be showing as revenue this year or should we be deferring it? I'm going to ask my auditors. I'm going to say, okay, here's our thinking. What do you think? Because remember, it's our financial statements and they're just expressing an opinion on it. But if we can ask them to help us sort of make sure we're following GAAP and getting their input on GAAP because they do so many audits in a year, whereas we're only looking at this piece of revenue once a year. If that, most of those questions are things that we haven't seen before. So we'd like to hear their opinion because they see a lot of different things day to day. So that's what we're looking for in an audit, is this opinion from the auditors. When the auditors show up, they ask for a lot of documents. And they're going to especially ask for your general ledger, they're going to ask for your trial balance, and they're going to do what they call testing. They're going to pull a few random things of each thing, and they're going to say, show us this, show us this, show us this. And if what you show them complies with your policies and procedures, because number one, GAAP, do the organization's policies and procedures comply with GAAP? So they're going to look at those policies and procedures and other standards and regulations. So they want to make sure that you have policies and procedures in place to adhere to everything you need to adhere to. Next, they're going to look at whether you're complying with it. Are you complying with your own policies? So we have a journal entry here. Did you prepare it the way you say you prepare journal entries and have it reviewed the way you say you have journal entries reviewed? And then they're going to look at risk management. Might the organization be exposed to any financial or legal risks? So they'll ask for, contracts for future years for a venue, for a meeting or something of that nature. They really want to look at your policies too. As we said at the beginning, they want to look whether you're segregating duties. So when you've got a check coming in the door, do you have multiple people touching it? Best case scenario, you've got at least 2 people opening the mail at all times. That is not possible in a lot of smaller organizations. But you certainly do not want the person who is opening the mail depositing the checks. And you do not want that person recording the checks in the general ledger. You want multiple people to touch things so that we know that we have the best case of no one is trying to do things that could go wrong. And we don't even want the look that it possibly could. And that's what the auditors are looking for. They're not looking for the fact that no fraud was perpetuated against the organization. They want to make sure that the organization has the policies in place to prevent fraud from ever being able to take place. They want to make sure you're documenting all your employee changes. When they show up, they want to see your personnel action forms. They want to see your I-9s. They want to see a lot of documents. And they'll just take a sampling of your new hires or your terminations or your changes, promotions, things of that nature, and ask for the paperwork and make sure that you have filed it all away properly. And they're going to look again for that audit review of all your transactions. Did you follow your own rules when you did things? Once they've tested things, they've looked at this sample they've asked for. If they determine anything didn't comply, they're going to dig a little deeper into that one thing. They're going to check a few more because if they feel like, 1 out of 5 failed, what does that say about the rest? So they're going to dig a little deeper and make sure that, that it's not 20% across the board, that this was just, they happened to pick one that came up that way. Depending on the size of the organization, audit field work may take a few days to a few weeks. Those who've been working with nonprofits for a while probably remember the days when an audit when the auditors were all in a conference room for a couple of weeks at your organization. Now, of course, most audits are taking place virtually, because of the fact that we've all moved to a virtual environment since the pandemic. But, some auditors will still want to show up, and they'll want to see your, say, personnel files, because those are the one things we tend to still keep some personnel files in paper. A lot of organizations have moved to completely virtual, but there's still some paper forms out there. Okay, so once we've completed the audit, we then get the 990 completed. The 990 can be completed by your own team. It can be completed by your auditors. It can be completed by someone else. It is not a violation of independence for your auditors to complete your 990, so sometimes they do it because they know your organization. So the Form 990 is an information return. It is due annually from every single nonprofit, and they submit it to the IRS. It's due generally for a year end of December 31st. It's due on May 15th, but you can extend it to November 15th. But it's always due 4.5 months after the end of your fiscal year. And it is sent to the IRS, and it is a public document. So the minute you have submitted it to the IRS, you are required to have it available to anyone from the public who would like to see a copy. GuideStar.org also posts Form 990s for all nonprofit organizations, as does the IRS. As a matter of fact, I pulled the Housing Assistance Council's this is for the year ended 9/30/2020. This was on the IRS website. Because it's a public document. All 990s are, but there are 2 copies of a 990. You have what's called a public disclosure copy, and you have the file copy for the organization. And we'll touch a little bit later as to what shows up on that file copy for the organization that is not publicly disclosed. But you can see here, this is what we're going to show the organization. The first page of the 990, this is just the top part of the first page, but it's giving you basic information about the organization, their address, their website, what type of a 501 what type of nonprofit they are, in this case, a 501c3. Want to know what type of entity you are. Now, I believe a nonprofit could be other than a corporation, but I've never seen that. All my clients have always been a corporation. And it shows here that this corporation was formed in 1971, and its state of legal domicile is the District of Columbia, meaning it was formed under DC law. And then it does ask, is this a group return for subordinates? Because they want to know whether you have multiple organizations that are reporting together. So down at the second half of the first page, they're really giving you a quick snapshot of the organization. It starts with the mission statement right up top. That is what this organization is about. It then wants to know, how many voting members do you have of your board? How many employees did you have? This is a really quick snapshot of your organization and the number of volunteers. Like, how are you supported by the public? And then it's showing that year over year, look at revenue, expenses, total assets, total liabilities, and the net assets. So this shows how your organization looks overall for the past 2 years. The bottom line is the most important, of course, because it is your net assets. What do you have left after all this activity that you've shown over these 2 years? I mean, in this case, you can see at 9/30/2020, Housing Assistance Council had $28.5 million in net assets, a very healthy balance for the organization. So even though it shows a loss for the year, it has the ability to sustain a loss in 1 year or even a few years because it does have a strong, healthy balance sheet. And then we move on to page 2 of your 990. These 2 are the most important in terms of showcasing who you are as an organization, because here is where you're going to talk about what you do as an organization and what is the most important programs that you have. So briefly describe the organization's mission. So we had the mission statement on page 1, but we want to keep it short and sweet because we want it just to be sort of that, sound bite that's showing up right at the top, because you never want it to be too long to fit into that space provided, nor do you want it here to be too long, because whenever we have overflow, it goes to Schedule O, and few people are going to dig in to finish a sentence over on Schedule O. So I always suggest that you make sure that it fits right there in terms of your organization's mission. And then down below, we have the programs. But in this case, and I don't know if this is software related as to what kind of software the team that prepared the 990 had. I actually think we might have prepared it. Markham did. So I think this is software related, but as you can see, the descriptions for the programs didn't fit. But we do show the expenses for each of the big programs and the revenue for those programs that's specifically for those programs. And then we have the total amount of program expenses down at the bottom. So 5.65 million for the year. I did go towards the back of the 990 and found those program descriptions. So you can see, here's what the organization is telling the public are the big organizations of the big programs of the organization. It's the lending program, knowledge sharing, and research and information. So those are your first 2 pages of your 990, the core mission and where we're investing our resources. Beyond that, there's a whole lot of questions. They want to know about your governance. They're going to ask whether the entire board has seen the 990 before it got filed. They're going to ask whether you were audited before you submitted your 990. Lots of questions. Do you have any conflict of interest? Do you have, board members who are involved with entities that are doing business with the organization? This is all informational purposes. There's no right or wrong answers. And then there's a bunch of questions that determine what additional schedules you're going to need to provide with your 990. So some of the big schedules you're going to see, especially for 501c3s, are going to be your Schedule A. It's going to be whether or not you are determined to be publicly supported. As all 501c3 organizations need to complete this schedule. It's a 5-year rolling calculation of whether you are supported by more than just a few people. They want to make sure that you have individuals and foundations and government grants that are, coming together to support you. It's not just 1 or 2 people, or 1 or 2 foundations for that matter. Schedule B would be your schedule of contributors. They want to see sort of who's giving you the most money. Both Schedule A and Schedule B have information that you don't want to share with the public, because the public support test is going to have some of your donors who gave you more than what's called the threshold of 2%. That is divulged on your own copy, but it does not go out to the public. They do know what your public support percentage is, but they don't know what contributors you have that went over the threshold. Same with scheduled contributors. This is generally 5 donors who give you more than 5,000. And I want to say 2%. I can't remember exactly. I don't do Forms 990, but again, the copy that's going to be publicly disclosed will only have numbers and will not have names and addresses as the copy you keep are. You're also going to have schedules that show your lobbying activities, if you have any lobbying, supplemental financial information, perhaps something about your fundraising activities, perhaps things about your compensation. So all these things are determined by the questions you answer in the beginning, whether you have to add additional schedules to your 990. Again, it's a public document, so it's something you want to be careful about, and you want to make sure that you agree with all of it, and it really sort of says everything you want it to say about your organization. Okay, well, that is the wrap up. I know it was a very quick overview. But happy to answer any questions folks might have. Or if you'd like me to sort of elaborate on anything I've touched on today, please let me know.
All right, all right. Thank you so very much, Trish. We certainly appreciate the wealth of information. We are now at the point where we're going to move into the Q&A portion of the webinar. We're going to begin with the questions that appear in the chat area, and as time permits, we'll move into verbal questions if folks want to ask questions of Trish verbally. So for all of the shy types, if you're anything like me, please take this opportunity to start populating the chat area with your questions, and we will get those answered. So Trish, I will give you the first question. The first question actually comes from Michael. He wants to know, how do you recommend that nonprofit housing developers treat budgets for housing developments? The question is rather, items that will be capitalized should be placed on a separate budget.
Okay. So yes, so good point. Capitalization, meaning that a fixed asset is anything that's going to last for more than 1 year in time. So you're going to be using that asset for more than 1 year in time, and it's of a certain threshold. So, I mean, I have staplers on my desk that I probably had on my desk for the last 20 years, but I would not capitalize those because it cost me $20. So you want to set a threshold for your capitalization. The IRS recommends a threshold of no more than $5,000. So they have some rules around it as to whether or not you have an audit. I think if you have an audit, you can use $5,000 as your threshold. Most nonprofits use $2,500 or $5,000 as their capitalization threshold, meaning that if something costs more than that limit, say $5,000, you're going to do what we call capitalize it. You're going to create a fixed asset out of it, and then you're going to spread the expense out over the course of the life of the asset. So if you build out on if you've got an office and you have a 15-year lease and you do some changes to the space, those are going to be spread out over 15 years because that's how long you have the lease. However, say you have a vehicle, we generally recommend about 7 years. At this point, a computer, we always recommend about 3 years because computers just, they age out faster than most other things. So we're really trying to show what the useful life of the asset is. So there might even be instances where your useful life is different than someone else's useful life because of how you use things. But yes, capital budget should be a separate budget because it's not going to show up as an expense until it starts to get depreciated. So yes, I would create a completely separate budget. I would show them what the impact is going to be on the expense on the other side, but the board should know what their cash outlay is. Some organizations, they have significant depreciation, so they'll even take that out of the budget so that we understand what the cash budget is versus what the actual expense budget is. But that all depends on the circumstances of the organization.
All right. Thank you. The next question is from Claudia Shea from out in Hawaii. Claudia says, I understand the administrative track of revenue and expenses. Is the development track fundraising? How do they relate to indirect expenses? So really a two-part question.
Yes, development is fundraising. I apologize. I did see that pop up at some point during the conference. Yeah, I mean, I do tend to speak in sort of nonprofit speak. So when I do, I appreciate people calling me out on it. It is fundraising. And it too will be given indirect expenses. As I mentioned, we typically base everything off of salaries, and salaries are based on timesheets. So you take everybody's timesheets and you allocate their individual salaries based on their timesheet. Say I am a program person who has to help with the annual fundraiser. So this week, I'm spending 20 hours on my program like I always do, but I'm being called out for 10 hours to help with a fundraiser, call up some funders. I'm a very small organization, so we all wear many hats. So I'm going to say I spent 20 hours on my program. I'm going to say I spent 10 hours on fundraising. Maybe I spend 10 hours on admin, not likely, but maybe I have another program I'm starting up and I'm going to put 10 hours towards that other program. So my salary is going to be allocated that way. 25% of my salary for that week is going to go towards fundraising. And so we're going to bundle everybody's allocations of their salaries, and we're going to allocate other expenses that are for the whole organization based on those salary allocations, including we're first going to do it with benefits. But we're going to take all the cost of our benefits and allocate them across according to how we allocated our salaries. But then the rent, we're going to allocate the rent out doing that as well, or the cost of the copier, the lease for the copier. We're just assuming everyone is using the copier according to sort of how they're spending their time. All the IRS says is you have to have a substantial reason for the way you're allocating your expenses. There are organizations that choose to allocate expenses a little differently. For instance, rent. Some organizations actually allocate rent based on how the space is used. That is especially true for organizations where they host the programs within the building. So it might be that you're a YMCA and your fundraising team only gets one office upstairs in the back corner, and so the program is using most of the building, but your fundraising expense by salary allocation would be considerably higher. So you could say to the IRS that there's a reason why you're not using salary allocations for this is because you are using your building as your program. So it all depends on who you are as an organization and what you do, but you do have to have substantial support for why the way you're allocating expenses is appropriate.
All right, thank you. And so Isabella, I hope that answered your question because that was the question that Isabella had. The next question comes from Peter Carey. Can you talk a bit about fund-based accounting?
Fund-based accounting. So it's interesting because I've had a lot of these discussions with clients. So we still do fund-based accounting, but we don't quite do it the same way. And today's accounting programs are not set up really to do it the way it used to be done. It used to be that each program was siloed into its own and it would do a due to from a main program. Now what we do is we look for the revenue minus the expense, and that's what's left for that program. And that's really what the net assets available for that program are at the end of the day. So when we looked at here, I'll even back up. Well, I didn't do the ending net assets, but as you can see here, sort of you take your change in net assets, you add your beginning net assets, and then you get your ending net assets. Well, if we did that by program here in these columns, you would find out what our net assets are, what our remaining funds are for each and every program. So it is still done. And in theory, we come up with the same result, but accounting programs don't function, the same way they do. But you know what? That's a great idea. And I think I will add that to these slides for the future, because I did notice in looking at these slides and talking to you all that I erred in my budget even because I should have had more money coming into I typically can't take something from a program. Why did I do that? So I typically couldn't take something from a program and move it over to others. So it's not like program A could really fund other programs. So it would be more that we have to show a positive change in net assets in the administration side of things to fund programs, because that is our unrestricted net assets. And unrestricted net assets, we discussed before, without donor restrictions, those are our hardest dollars to raise. And that's why you see a lot of nonprofits today still have fundraisers, even though it is a lot of work and it's not a pleasant experience. They do the fundraiser so that they can bring in money that is not restricted, that they can spend in any way that they think is most appropriate.
All right, thank you so very much. The next question comes from Nancy. Nancy wants to know, what's an example of a qualified opinion?
Qualified opinion would be, they're saying that there was just a few things that they found that are wrong. I'm trying to think if I've had a qualified opinion. I'm trying to think of what I've seen. It could be that they found that you recorded something that was incorrect. If they find it to be material. In my mind, and I'm sure every auditor is different, anything below 2% would be considered immaterial. They're not going to care about it. But if they find something that they think needs to be changed that is greater than their threshold of 2 or 3%, that would be something that does not comply with GAAP. No matter what they find, they're going to tell you to make changes to your financial statements. They're going to give you a list of audit adjusting journal entries. However, if they're not material, it's not going to change their opinion. But if it is material in their mind, they're going to give you a qualified opinion and say, you did not adhere to GAAP. And so we're qualified. We're not saying that there's something wrong. We're not saying that this is so bad that we can't, go forward. But we're just saying that be careful. We think that financial statements are pretty good, but they're not perfect, and it could not be. No auditor is going to tell you they're going to find fraud. They're just there to sort of make sure that you're complying, but they'll tell you right off the bat that they are not there to find fraud. I'll admit that the one thing I did not want to do when I went into accounting was to be an auditor. So I've never been an auditor, and I never will be. And so I can't, sort of speak more to that. But you can always ask your auditors, because, they actually, they want to share what they do too. So I love what I do. I hope they love what they do.
All right, thank you. The next question comes from Mary, and Mary wants to know, are salaries or compensation for top leadership listed on the public disclosure copy of the 990s or the file copy for the org?
They are on the public copy. The salaries of your key employees, your highly compensated employees, are all on the public disclosure copy of your 990. I still remember when I heard on the news years and years ago about how the NFL used to be a nonprofit. And yes, I needed to go look up that 990 and see a $41 million salary on a 990. It was there. Yep, had to see it.
All right, next question comes from Kenneth, and Kenneth wants to know, when creating a proposed budget for the board to approve, is it best to create the budget based on short-term financial goals or long-term?
I know you're not going to like this, but both. You really have to look at sort of how you're investing assets today with the goal of your long-term goals, because you don't want to invest one way now and then pivot at the end of the year. You want to really think about what your long-term goals are while you put together a short-term budget, which is for that 1 year.
As Stephanie has outlined in the chat area here, if you would like to ask a verbal question, go ahead and use that raise hand function. We are at the last question that's appearing in the chat, so now would be a great time to go ahead and raise those hands if you have a verbal question. Our last question in the chat comes from Chris. Chris wants to know, well, he states we are an all-volunteer nonprofit. Some of the volunteers have been asking for a deduction letter for their time as a charitable contribution. I am having some heartburn supplying the letter. We do not show any personnel expenses due to being all volunteers. And so it's really a statement, more so a question, to get your reaction.
Well, the time that they give you is not something that they can deduct. So that's not, again, I'm not a tax accountant, but I don't know that that's truly valuable to them. Basically, any organization, especially if you get an organization that provides professional services, they'll give you that letter and show you how much what they provided to you is worth, but they don't get to deduct it because they get to deduct all their expenses, period. So it's more for your financials. If you have people who are providing services that cannot be, that you would pay for otherwise, so it can't be volunteer services that you wouldn't pay for otherwise. It has to be something that the organization needs. Board members would not count, because typically we do not compensate board members. But if you have someone who's providing accounting services that you desperately need, you could record both the revenue and the expense for those accounting services, because whatever in-kind services you receive would be both a revenue and an expense. I have never seen an organization give something to the person providing the services. I always see the opposite of the person providing the services giving it to the organization, so the organization can record that in-kind revenue and expense. So you know that revenue and expense does not show up on your 990. That only shows up on your audited financial statements.
All right, and our last question for the afternoon goes to Michael. Michael wants to know, does the budget include only activities that are currently funded? For instance, he has a project that he's planning to start in the coming year, but he doesn't have a grant to fund it yet.
So the budget should include all activities that you plan on, for which you plan on expending funds in the coming year. This would be an instance where you would have to take the net assets of the organization to fund that activity until that activity is bringing in its own revenue. This is where those undesignated net assets are so key to an organization, because they allow you to do things like, expand, to invest in a new program, to invest in something else, or to even sort of cover expenses during a period of time when you don't have revenue coming in that you anticipated. So those, undesignated net assets that have no donor restrictions are really key to an organization's long-term health, because they do allow you to do things like expand because you have those net assets available to invest into that program.
All right. So we are now at the top of the hour. And so I want to ask folks to please join me in once again thanking our presenter for today, Trish Kelly, for the wonderful information. I also want to thank each of you for your time and participation during today's webinar. As we close, please be on the lookout for a survey following the webinar. We ask that you take a quick moment to please fill out that survey. That's the way that you tell us that we are bringing the most relevant information and content to you based on your programs and services. And so with that, thank you again and enjoy the rest of your afternoon. Goodbye.